Now, when most of us think about investing, we usually picture big familiar names, companies like Apple, Nvidia and Microsoft in the US, or BT, NatWest and Tesco if we're in the UK and thinking about businesses closer to home. But what about companies in other parts of the world? Most investors never look beyond those familiar names, and for a long time that was fine. But the geography of global growth is shifting. Consider this: nearly 2/3 of all the economic growth to be generated between now and 2035 is forecasted to come from emerging markets, with their economies projected to grow at more than double the rate of advanced ones. Now, this is relevant for one reason. The growth story of the next decade is to a large extent playing out somewhere most UK portfolios barely touch. So what exactly are emerging markets? Why are so many investors drawn to them? What are the risks you'll be signing up for? And as a UK investor, how would you even go about getting some exposure? Hello, I'm Brian, and today I'm here with Moneyfarm to talk about emerging markets, so that by the end you'll understand what they are, why they're exciting, the specific risks to weigh up, and exactly how to invest in them sensibly from here in the UK. So let's dive in. Let's start with the basics. What actually counts as an emerging market? In short, these are the countries on the move, so economies that are growing fast and industrializing as they make the journey from developing to developed. Think places like China, India, Brazil, Taiwan and Mexico. They're spread right across the globe from Central and South America through parts of Europe, the Middle East and Africa, all the way over to Asia. So they're a hugely varied bunch, each with its own character, its own challenges and its own opportunities. What ties them together is that sense of momentum. Between them, emerging markets are home to the majority of the world's population, and they're the engine behind a growing share of global growth. They might feel less familiar than our usual investing stomping grounds, but with all that growth and development going on, you'd expect there to be some real opportunities for investors. And there are. So let's look at what's actually driving them, starting with some numbers. Emerging markets are home to the majority of the world's population, and they're expected to generate nearly 2/3 of global growth by 2035, with their economies projected to grow at more than double the rate of advanced economies. A few big forces are powering all this growth, and they're worth understanding because they're really the reason investors get excited in the first place. The first is sheer building. As these countries develop, they often have enormous infrastructure projects going on. Think new roads, high-speed railways, metro systems, airports or energy networks. So the kind of construction that reshapes an entire economy. The second is technology, and here's something interesting happens. Many emerging markets are adopting new tech at lightning speed, and in a lot of cases they're actually leapfrogging, skipping over older systems entirely and going straight to the latest thing. Mobile payments are the classic example. Plenty of these economies went almost directly to paying by phone without the decades of checks and card machines we went through. Third, some of these countries are sitting on a lot of the critical minerals the world needs for the global energy transition, the raw materials that go into batteries, renewables and the like. And fourth, many have huge young populations. That means an expanding workforce, and as living standards rise, a growing middle class with more money to spend. And that spending fuels more growth and drives more innovation, and round it goes. Put all that together and it's not hard to see why emerging markets are so appealing to investors. But there's actually one more reason investors look here, and it's a quieter one: diversification. Emerging market shares don't always move in step with developed ones, so holding some as part of a broader portfolio can help spread your risk and smooth out the overall ride. When developed markets are having a rough year, emerging markets might not be, and vice versa. So from an investment point of view, there's clearly a lot of potential. But, and you probably sense this coming, all that potential arrives with strings attached. Here's the thing about high growth potential. It tends to come hand in hand with higher risk, and emerging markets sit firmly at the riskier end of the spectrum. So it's worth understanding exactly what you'd be taking on. Start with political and regulatory risk. Some emerging market countries have less stable governments than we're used to in developed economies, and that can mean sudden changes to laws, regulations or taxes. For the businesses operating there, that's disruptive. For investors, it's uncertain. Think about what happened to foreign investors investors in Russia in 2022, or the regulatory crackdowns that hit Chinese tech stocks almost overnight. These things do happen and they can move fast. Then there's currency risk. When you invest overseas, you're not only betting on how well the companies do, you've also got the local currency to think about. If that currency weakens against the pound, it can eat into your returns, even when the underlying shares are performing well. And emerging market currencies can swing around a fair bit. Imagine a Brazilian company grows 15% in local terms, but the Brazilian real falls 15% against the pound in the same period. From where you're sitting, your return is roughly zero. The company did well, but the currency wiped it out. And then you have the risk of liquidity. Because these markets are less developed, there can simply be fewer buyers and sellers, which can make investments harder to trade, particularly when conditions get choppy. Then again, you have the so-called governance risk. The reporting standards and oversight frameworks aren't always the same as in developed markets, so it can be harder to get a clear picture of a company and properly weigh up the risks. And finally, volatility, which, as I said, is really the flip side of all that growth potential, as prices here can rise and fall quickly and sharply more than what happens in developed markets. To be clear, none of this is meant to scare you off. You just need to make sure you go in with your eyes open, because the key isn't to avoid emerging markets altogether, because the growth potential is meaningful, but you need to treat them as part of a broader and properly diversified portfolio, sized to match your goals, your time horizon, and how much risk you're genuinely comfortable with. Because emerging markets as your whole investment strategy would be like putting all your eggs in a fairly bumpy basket. On the other hand, emerging markets as a measured slice of a broader mix, well, that's how most people sensibly get exposure to that growth without betting the house on it. Which brings us neatly to the practical question. If you do want some emerging market exposure, how do you actually go about getting it? So let's get practical, because the most obvious ways to invest in emerging markets don't actually work for most of us. Take buying individual shares. Picking up shares in a UK, European or US company is straightforward enough for a UK investor, but getting direct access to emerging market exchanges is fiddly, sometimes costly, and in some cases simply not possible for the average person. And that's before you've taken on the job of researching and analysing companies dotted all over the world. So for most of us here in the UK, the sensible route is funds. A fund bundles lots of investments together so you can buy them in a single transaction, and that's been transformational. It's given ordinary investors an affordable way to own a stake in everything, from a retailer in Africa to a chip manufacturer in Asia to a financial firm in South America. And that's because you're buying into lots of companies at once. A fund spreads your risk automatically. The most popular type for emerging markets is the ETF, the Exchange Traded Fund. An ETF tracks a particular index, so in this case it might follow something like the MSCI Emerging Markets Index or the FTSE Emerging Index. In practice, when you buy a single one of these, you gain exposure to hundreds, even thousands of companies across multiple countries in one go, with your returns roughly mirroring that index. One quick word of caution on those indices: they don't all define emerging the same way. The MSCI index includes South Korea, for instance, while the FTSE one doesn't. So if there's a particular country you're keen on, it's worth checking what's actually in there. If you'd rather not simply track an index, the alternative is an actively managed fund. Here, a manager or a team handpicks emerging market companies they believe will beat the benchmark. The upside is they could do better than the index. The catch is there's no guarantee they will. They might do worse, and you'll usually pay more in fees for that stock picking. Whichever you choose, you'll typically buy these funds through an online platform like Moneyfarm, where you need to open an account and then pick your investments in a few clicks. And it's well worth knowing that emerging market funds can sit inside a stocks and shares ISA, so any growth is shielded from tax. We've got a full video on stocks and shares ISAs on the channel if that's new to you. So, in a nutshell, first, emerging markets are the world's fast-growing economies, like China, India and Brazil, and they're set to drive a big share of global growth. Second, the opportunity is real, but so is the risk. Think currency swings, political wobbles and plenty of volatility. Third, for most UK investors, the smart way is through funds, ideally inside a stocks and shares ISA, held as one measured slice of a diversified portfolio. And there you have it, your quick guide to investing in emerging markets. If you found this helpful, please subscribe and check the description below for more on Moneyfarm and how to start investing today. And as always, I will see you in the next video. Bye bye for now.